Today, we got headline whiplash. We got two headlines that hit us back to back a couple weeks ago. Trump talking about potentially banning institutional investors from investing in single-family renters and asking for the GSEs. What's GSE stand for, GC?
Government-sponsored entity.
Government-sponsored entities. That's another word for Fannie Mae and Freddie Mac, right?
Yep.
Asking them to buy back $200 billion worth of mortgage-backed securities. We're going to unpack what these headlines mean and what it means for rental property investors. Welcome everybody to your weekly edition of the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me in studio, I feel like we haven't done this thing forever.
I missed you, buddy.
The guy that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flow, is a great co-host, and his name is Gregg Cohen. Say hello, Gregg.
Hello, everybody. Fantastic to be with you today.
Gregg, I know that we haven't been together here at studio for a while. Good thing, because we got some breaking news. Big update for the Not Your Average Investor Summit. As you all know, it's happening February 19th and 21st, 2026 here in Jacksonville, Florida. You can buy tickets by going to jwbrealestatecapital.com/summit. But big news, GC. Why don't you tell the people the big news?
We're super excited. We get to welcome Jacksonville's mayor, Ms. Donna Deegan, to the summit. She is going to be speaking at the summit. You all will get to meet her, and she will be there to share her thoughts on her vision for downtown, her vision for Jacksonville overall, and then she'll be a part of a downtown panel. It won't only be the mayor. It will be the CEO of the Downtown Investment Authority, Mr. Colin Tarbert, as well as City Councilman Jimmy Peluso, and then our very own Alex Zafakis, the president of JWB. This will be a panel that you will absolutely not want to miss. We're going to be going into detail about the $6.5 billion of downtown development happening here in Jacksonville, and specifically JWB's Gateway investment, which is $2 billion.
And it's totally tangible right down the street from where we're going to be.
And then we're going to walk it.
And then we're going
to walk it.
Yeah.
So if you haven't signed up yet, we do have a few tickets still available. Please go sign up. We're going to be sold out here pretty quickly, and it's something you do not want to miss.
Joanna dropped the note in the chat for where you sign up, but it is jwbrealestatecapital.com/summit. Your partner, Alex, always a hit at Summit. Always a hit on the show as well. Jimmy Peluso is a guy that brings a lot of energy, a lot of enthusiasm into downtown. The mayor, we haven't had her at the summit yet before.
I know.
We've had her on the show.
I know.
You know what I love about the mayor?
Yeah.
As you know, I have a adorable puppy that I'm raising in my home.
Oh, yes,
and
Miss Piggy.
And I take Miss Piggy to walk on the beach like a half hour before the sun comes up when there's nobody there. You know who's there on the beach?
The mayor.
The mayor and her husband are running every single morning on the beach. I think it's the coolest thing ever.
Yep. No, right? She is all in for Jacksonville. And since she started her term as mayor, every single day her message has been about a better Jacksonville and inclusivity.
Yeah.
And when we're so lucky to have her in the studio for the show not too long ago, it was really wonderful. It was the first time I had met her in person, and everything that she had been preaching, I felt it. I felt it right in that room, and with her message. I think we all did, those who were there for the show. So super excited and honored to have her there.
Yeah, super pumped to have her there. Gonna go run her half marathon in a couple of weeks.
Oh, that's right. Yeah.
You're gonna run it. I'm probably gonna mostly.
Yeah, I know. You've been struggling, bud.
I'm still gonna do it. I'm still gonna do it.
Are you?
Yeah, I'm gonna do it. I'm just gonna probably walk most of it.
Love it, man.
I'm struggling, but
sweet.
You can go at your own pace. Yeah, pumped to have the mayor in the summit. That is momentous, man.
It's big
really
step
cool.
for us.
Really cool. Really cool. All right, so we got more breaking news, GC. We had a question pop up from the show talking about Jacksonville population growth. GC, what'd you find?
Yeah, so this was coming off the heels of the quarterly market update where we shared a lot of great data, and I think it was Mike Foster who asked this question. I could be wrong, but he asked about
questions.
He's the man with the great questions, of course. He was asking about comparing Jacksonville's population growth to home sales in Jacksonville, because in the quarterly market update I said, hey, listen, home sales today are like 2,800 home sales. 28,000 home sales in Jacksonville. That's basically where we were pre-pandemic. And so he said, well, I'm curious to know what has happened with Jacksonville population growth compared to home sales if we went from 2019 to 2025. And I thought that was a really good question, because as your population grows, you would expect your home sales would also grow at a similar rate.
Would make some sense.
So here's the stats from 2019 till 2025. Jacksonville's population has grown 14%, one of the highest growth rates in the entire country. Now, our home sales in 2019 are just about what they are last year in 2024. So our home sales are flat from 2019 to 2024. Now, you can look at this a couple of different ways. You can say, oh, geez, well, home sales are lower than what we would expect because 0% growth of home sales is less than 14% growth of population. And you could say, oh, well, geez, we haven't grown as much in home sales. But the reality here is think about what's been suppressing housing demand over the last year and years, right? Our home sales have been suppressed because of high interest rates, right? So, the home sales number about 28,000 compared to the same number in 2019 is actually showing us, number one, that things are selling here in Jacksonville. And then number two, that we have suppressed housing demand that should be recaptured in the coming years, which will likely lead to home price appreciation over the long haul for investors.
Okay, talk me through that. So even rate means that things have been selling, right? Because we've been selling at the same rate as we were in 2019 when we were already. Do we know what we were growing in 2019? Like, couldn't we also have been at the same 14%?
Help me understand the question.
Like, if our population rate since 2019 has grown by 14%, wouldn't we have to know how much we were growing at that point to know if there should be a difference between like what the home sales rate was then and now?
I think we might be transversing a couple of different things here or whatnot. So in 2019, it was saying the number of home sales is 28,000.
Okay.
And I don't know what the population growth rate was prior to 2019. Yeah. So I don't know the year before. I didn't look that up. So if we wanted to figure out how much we were growing and was it commensurate with the number of home sales in 2019, we would have to do research to figure out what it was prior. But what this is saying is that normally you would expect home sales to grow at a rate that's similar to your population growing.
Okay.
Unless the percentage of ownership changed and renter changed and all that, but it's getting into the weeds here. So normally if your population grows 14% during a time period, you would expect your home sales would probably grow somewhere similar to that. There, So when I shared this data that home sales are 28,000 and it's the same number that it was in 2019, that was to show, hey, listen, things are selling here. This negative narrative of how nothing's selling in the real estate market is just not real in Jacksonville.
Yeah, got it. So we still have 2019 was a healthy market. We had that many sales. That's still happening.
Yeah, exactly. And then you can look at, well, what has the effect of high interest rates done to suppress demand?
Got it.
And that's really the delta between, call it 14% of population growth versus flat number of home sales from 2019 to today.
That makes sense. People have been moving here at a 14% clip year over year.
Not year over year, total.
Oh, total. Total. And the same amount of home sales have happened, and it is not far out there to believe that a lot of the folks that have moved here have been thinking, cool, I'm moving here, I like it here, but I'm waiting until interest rates drop before I purchase my home here. And therefore, we believe that there is a population on the sidelines that's waiting for that to move, aka suppressed demand.
Bingo.
Okay, got
Bingo.
it. Yeah, that's an interesting tidbit, buddy.
Yeah. This comes from Mike Foster, the man with the great question.
Great questions from Mike Foster. All right, GC, I got a couple of questions. There's been a couple of headlines. I don't know if you've heard, right? Let's go. So the two headlines, right? Trump announcing that he sees that there's an affordability issue with homes. He wants to do something about it. He's proposing a couple of different things, right? The first thing that he is proposing, this is basically just like an announcement of, hey, here's an idea, right? I don't think he's actually put forth any kind of...
Correct. This is a proposal.
This is a proposal. This is just like a tweet.
This is a tweet.
It's a tweet.
Or whatever it's called.
Saying, here's an idea. How about we ban institutional investors from buying single-family homes, from buying single-family homes for the purpose of renting them out to families, right? So SFR, single-family rentals, believing that if you can tell these like institutional investors not to buy these assets. Now the family that like may need it to actually live in doesn't have to compete with somebody with a bigger bank account than them.
Right.
That might allow them to find better deals on homes as they move in. That's essentially what he is floating out there as an idea. What do you think about that?
I think it's a whole lot of headlines without any real help to affordability. And it's great, the data that and the consulting that we pay for, John Burns Real Estate Consulting. Just after that was announced, my inbox was filled with such amazing data and reporting specifically on this topic that I wanted to bring a lot of data and perspective to this topic through the show here today. But at the end of the day, the punchline here is that while people can relate to the narrative of like, I don't want the big bad institution coming in and owning my neighborhood, the data just does not support that is actually happening.
Yeah.
And I'll give you some of the data. Institutional investors.
Well, first, let's talk about what is an institutional investor, right? An institutional investor, I think, for this definition, is somebody that owns over 100, like a group that owns over 100 or over 1,000 rental properties.
Yeah, there's no defined what is an institutional investor. So the data that we can share is actually broken down. Sometimes institutions or investors that own over 100 homes, and sometimes it's over 1,000 homes. But it's really any big institution, let's call that, owns 100 or more homes.
100 or more homes, right? So he's basically saying these people are buying up too many homes.
Yeah, I think his actual comment was something along the lines of ownership isn't something that should be an investment. Ownership in single family homes and neighborhoods isn't something that should be an investment. And I want to bring affordability to all so that the institution doesn't come in and price out, Susie homeowner who wants to buy that home.
Got it. So are institutions buying a lot of homes right now?
No.
Okay, I think this is the data that we're going to talk about first, right?
No,
I think we're talking about like, are they buying a lot of homes? And if you ban them, will prices go down? Right?
And let's go one step farther. Were they ever buying a ton of homes?
Buying a ton of homes?
No, they weren't. I'm going to show you the data here. But yeah, this is one of those narratives that makes people feel good that like none of us want like institutions owning our neighborhoods and whatnot. But the data just has never supported that institutions have been a predominant player in single family homes. And I'll share all that information with you here. So yeah, so here's a stat to know if you ever find yourself in a conversation with somebody who's concerned about this, right? Institutions only own about 1% of all single family homes across the US. And it's broken down by market here. It's really insightful to see it broken down by some of the biggest MSAs or metropolitan statistical areas. Jacksonville has been a more popular market for institutional investors, yet only 5% of all homes owned here in Jacksonville are owned by institutions.
And this is homes owned. This is not like how many rental properties are owned out of all rental properties. This is the population of homes that anybody could live in, owned by institutional investors.
Correct.
Either people that have over 100 or people that have over 1,000, depending on your definition.
Correct. And it's important to start with the big picture here, because the big narrative that we're trying to avoid is that the institution owns all of the homes in my neighborhood and that people get priced out. So yes, across all single family homes, institutions own roughly 1% across the country.
Got it. And in Jacksonville, a little bit more than that, because it's a really good place to have bought single family homes.
Exactly. They think like we do. What I share with you about why it's such a great investment in the 5 profit centers. Guess what? I didn't make this stuff up. Yeah. the big boys and girls at the institutions, they know it too, and that's why they have targeted Jacksonville over the years to buy more than in other places.
Quick question, because Jen is asking this in the chat. Is JWB like I would say like she's asking, is JWB an institutional investor? And I would assume that like y'all as a group, that when you and your partners own 400 properties, you may fall in that because you're north of 100, but your clients are not institutional investors. Right?
True. Yes, to your point, who we are and who we serve are not institutions, right? Our average client has somewhere around 3 properties in their portfolio. And so we do not serve institutions or hedge funds. That's not who we sell to. So is JWB an institution? I don't know what the definition of an institutional investor is right now. I think who really cares unless this ban goes into place? But
Sure.
if it's 1,000 homes, then JWB is not an institution. We don't own over 1,000 homes. Is it over 100? Then yeah, you would qualify us as an institution, even though, who we serve is not an institution.
Got it. Okay. So then again, as far as all the homes out there, less than 1% of them are owned by institutional investors, whichever way you cut it in that definition. As far as single family rentals, right? I think this is a really interesting statistic. There's 14 million single family rental units in the United States, and 3.4, if we're just condensing to rentals, are owned by institutions.
There you go. There you go. That is now we've gone from like our institutions owning all the properties in our neighborhoods to our institutions owning all of the rental properties across the country. And you have the same result. Only 3.4% of all homes across the country, all rental properties across the country are owned by institutions. And that's with that definition being those institutions owning 1,000 or more properties. So that would be like the big Wall Street type of institutions. Only 3%. And then you can even go one step farther and say, if you said the definition was over 100 homes, where JWB would be a part of that, right? The percentage only goes up to 7%. So 93% of all single family rental properties are owned by us, mom and pop investors, not institutions.
And this is total ownership today. This is not the number of like, they are buying 7% of the market right now as we speak, right? Like that does not, that like, if we were thinking about, because right, the first thing that we're asking ourselves is, are institutions buying all the homes? Right. Right. So like, fair to say they have not bought all the homes, right? If we're at a point where it's like 1% of total population, maximum 7% of all single family rentals have they purchased, right? Like if somebody owns 7% of my company, I would consider them a minority stakeholder.
There you go.
like a major minority stakeholder, right?
Exactly.
Like that, they're not really controlling interest there.
Exactly.
And then on top of that, there's the question of like, are they actually buying them today? If I am Pablo and Marta looking to buy our starter home in, like in a working class neighborhood, am I going to walk out there and make an offer and it's going to be against Blackstone or something like that? Are there any numbers around that of like what's happening now?
Yes, I'm glad you asked. And the answer, guess what, is no. You are not likely to go up against an institution if you're going to buy a home today in Jacksonville or across the country, because institutions are only buying somewhere around 1 to 2% of properties today. Yeah. And I think we have a slide on that if you want to show that one.
Is that what this is right here?
Oh, you know what? No, this one I thought was pretty cool. Why don't we, before we go to that next slide, why don't we spend a minute here? Because I thought this would be great for everybody to just know. I thought this was cool research, so I'll kind of share it with you. John Burns does a great job of understanding how many housing units are out there in the entire country, and then breaking it down through the households that are occupied and the ones that are vacant, and then the ones that are occupied, how many are owned and how many are rented. So I'll just kind of take you through the path here. There's 148 million housing units across the U.S. Of the ones that are occupied, there's 134 million households. So that's getting to the nice pie chart on the next one there. Because I can't do colors, we'll go to the next one. Of those, what is that? 65% are owned. So that's about 88 million units are owned. And that leaves about 47 million units.
Owner occupied.
Yes, owner. Thank you. Yeah. Owner occupied. Yeah. And then it leaves about 47 million or 35% being rental units. Okay. Occupied by a renter. So then you can break it down. Of the 47 million total rented units out there, how many are single family versus how many are apartments or mobile homes or boats or things like that? And you've got about 31 million units are apartments. What's that, about 66%? My eyes can't see that far.
It's 6%.
There we go. And that leaves you about 30% as single family rental properties, which nets out to about 14 million units. You can then break it down by the type of investor who owns those 14 million single family units. And so, yeah, there you go. There's your fun facts for today.
Super interesting. All right. So these are all the households. It's this like big pie right here, 134 million. Out of all those households, this is what we are talking about right now, right? Like this like whole slice of like renters, which is 35%. Out of this slice here, the majority are apartments, right? Like this like large majority, 66% are apartments. 30% is single family homes, and then there's like a little sliver of like boat homes and mobile homes and stuff like that.
Mm-hmm.
And out of that, up here, what does this say here?
So this is breaking it down and answering that question. How many of the single family rented units are owned by an institution?
Yeah.
And so if you define institutions as 1,000 or more properties that they own as the institution, their segment of market share is only 3.4%.
Yeah.
If you
this little sliver up here, right?
Exactly.
Yeah.
Exactly.
And then the ones that have 100 to 999, which is where you guys would fall into, own slightly more, 3.8%. But if you look at this entire kind of distribution here, it's like the whole battery is owned by either mom and pop investors or 10 to 99 or 1 to 9 properties, right? Like the folks that we know here.
Who I would call a mom and pop investor.
Yeah, 100%.
Right?
Mom and pop investors. And this, again, this is purely for the rental unit side of it.
Exactly.
Right. So seems like a pretty small number, right? So then I would venture to say that if our first question that we're asking is, are institutions buying up all the homes? The answer is a pretty profound no, based on who owns what already. And then this is the slide that you wanted to show, right?
Yeah. Question is, have institutions bought all the homes from all the headlines and everything that we've heard for the last 3-5 years or whatnot? The answer is no, because institutions own about 1% of all the homes across the country. And then of rental properties, only about 3%, or 7% depending on how you define it.
Yeah.
Well, now the question is, are they buying a lot right now? And this slide should answer that question. So institutional investors are purchasing only about 1% of all U.S. homes today. And
so if you're going to go buy 100 homes, you might compete with an institution in one of them.
Yeah, across the U.S. Yeah, absolutely.
The US, right?
100%.
Yeah.
Here's a couple interesting things on this slide. That graph shows the institutional buying activity going all the way back to 2011, 2012-ish.
Just post-recession.
Right? Mm-hmm. And so we have been hearing that institutions are buying 30%, 40% of all properties across the country for 3 years now, 5 years? I don't know. As soon as the market was on fire. Mm-hmm. But that's just never been real. So institutions have been buying, somewhere between about 1 to 2%. 1 to
2 for the entire time, except for maybe like 3-4 years here.
Exactly, when it bumped up to 3%.
Yeah.
Right? So
really bumped up to 3% twice. The rest of the time, it was below 3 still.
Exactly.
Yeah.
So it has been way overblown. The fear of this has really been generated by these headlines, but it just hasn't been real. And so no institutions haven't bought up everything, and no institutions are not buying up everything right now. So a ban on institutions buying properties today is really much ado about nothing.
Yeah. And that's basically the takeaway, right? Like the first question is like, are they buying up all the homes? No, they have not bought up all the homes. And right now they're currently not buying a lot of homes, right? 1%.
Right.
So if you were to just completely ban, institutions from buying it, it would be it would be like a tree falling in the woods, right? With nobody to hear it.
A very, very small sapling.
I remember when it reminds me of I had a history teacher that I loved in high school history class, Dr. Ramsey. And we were learning about the Alabama bus boycott, right? We were learning about the civil rights movement. Mm-hmm. And he was asking us, I went to a private school in Miami, Gulliver Preparatory. Mm-hmm. It's not where Fernando Mendoza went, but no.
Yeah, I was going to say, is that Columbus? Because everybody knows Columbus.
We competed with Columbus. We competed with Columbus. And he asked us, he's like, hey, what do you guys think would happen if every student here in Gulliver right now boycotted the Miami bus service? And we're like, well, I don't know. He's like, 0. Nothing would happen. None of you guys take the bus. Right? But in Montgomery, Alabama in the 60s, like African Americans boycotting was a large population of who took the bus system. Right? So it's like, you can have these like massive, grandiose like actions that you take, but if you're not like actually in, like you're not the population that uses it or transacts on it, it's not going to affect anything.
Yeah, exactly. It's the market share.
Yeah.
What was the market share of you in your high school class taking the bus?
0.
The market share of institutions either buying or have purchased, single family rental properties is almost the same market share as you guys taking the bus, apparently.
Yeah. Okay. Makes perfect sense. So at the end of the day, takeaways as far as that goes, institutional single family rental ownership is a very small slice of the U.S. housing market. Investors Institutional investors are only purchasing 1% of all homes. A potential ban would have minimal impact overall, namely, like specifically on home prices.
Wouldn't do anything.
Wouldn't do anything. And anything else that we need to know as far as institutional investors?
Yes, there would be potential big negative ramifications of the very thing you're trying to solve by doing this potential ban. We're trying to increase affordability. What's actually happening with institutions is many are partnering with home builders. JWB is a home builder as well, if you want to call us an institution, and we are bringing supply to the market because we are building 350 homes this year. And other institutions are doing the same type of partnership. So they're actually bringing inventory to the market at a time where supply and raising supply is the solution to affordability. So you could actually, depending on how this ban would go, if you banned the build to rent activity within an institution, you could actually be decreasing supply, which would not be good. It would harm the very thing you're trying to solve. And the other thing I wanted to mention right now, we showed how little home institutions are buying as far as home purchases today. Institutions today are actually net sellers. So if you count up the number of homes they buy versus the number of homes they're selling right now, they're actually net sellers because that's the nature of the environment right now.
Yeah.
They are redeploying their capital in different places. Interest rates are higher and all that good stuff. So they're not buying a ton. Well, they're actually net sellers. So when you're a net seller, you are actually adding supply to the marketplace as well. So institutions are actually serving a strong purpose to help with the affordability crisis right now. So banning institutions and then potentially even limiting their abilities to bring new supply to the market would be the opposite of what we need right now.
Interesting. I did not think of the idea. Well, so I assumed that our lesson here was going to say you can't wave a magic wand and all of a sudden get prices to like go down. We've been talking about it for a long time. Supply is the answer, right? Like we are chronically undersupplied in single family homes, and we need to like incentivize people to build homes, whether it's kind of like how we've talked about creatively by like maybe changing some zoning regulations around parking,
reducing red tape
and stuff like that. I didn't think that the other piece of this is like, yeah, when these single family homes are going to be built, these institutions are kind of the ones that will end up funding the bill in order to like build this type of stuff, because that's where like this money comes from.
Yeah, that's true, right? Rather than incentivizing through, incentive plans from government dollars, right?
Yeah.
A benefit here is if you just let builders build, which are funded by institutions through their partnerships, let them bring supply to the marketplace. Let's not restrict it.
Yeah, makes sense, man. It's counterintuitive, man. Like, I'm somebody that's like, damn the man, right? Right? So like to be here and be like, yeah, institutions are the answer. It's like, well, I mean, it's not an easy pill to swallow if that's what your internal narrative is. And I think it's really, really easy to like stoke those nerves on social media and be like, look at all these homes that they own and look how much they're worth. When in reality, you look at like the giant market of it all, and it's really not a lot of it. So it's just kind of an easy villain.
I think it is. Institutions are an easy villain. This is not to say that institutions are the saving grace of the housing market and affordability. Yeah. This is just a balanced perspective with real data here, right? There are things that institutions can do that really do hurt the housing market and hurt the renting experience and hurt the economy. That is very true. That can happen, right? But there are also things that institutions bring to the marketplace that are very valuable as well. And so the takeaway here is the ban does not help. This isn't saying institutions are perfect, and this isn't saying that they're going to solve every problem.
Yeah, man, that's what's missing in most of these, like our reactions to these headlines or these memes, right? It's like the nuance around it all, right? It's like, hey, this ban isn't going to help. It doesn't mean that there aren't things that we can do with institutions to make it better for everybody, more equitable, and like save the average consumer and whatnot, right? Like, I like that. We got a couple questions here, GC. Let's hit these before the next headline. Mike Foster, regular guy, extraordinary.
This is going to be a good one. I know it.
Given the popularity of Jacksonville for home investments, right? We showed that slide earlier about how Jacksonville is one of the ones where a lot of institutions actually bought. Is JWB finding competition tougher to locate more homes, to restore or land, or to develop?
Are we finding more competition to locate more homes, to restore, or land to develop?
Yeah, I think Mike's basically saying, like, given that Jacksonville is one of these markets where institutions did come in heavier than in other markets, I'll start with in current state. Do you find yourself competing with institutions right now when you are buying lots? And doing
No,
stuff?
we don't.
Okay. What about at the top of it, right? Like we showed kind of like in 2022, there was more like 3%, right? Or like 7% or something like that.
I don't think we really found a lot of, I mean, we knew that there were some players in town that were buying, but it's not like it, I mean, we bought what, 500 homes, 700 homes, you know, in 2020 and 2021. I mean, so no, it didn't have a material impact on our ability to buy, even when everybody was sort of up in arms about it.
In a concentrated place where you're the biggest buyer
Right.
and you still didn't really feel it.
Right, exactly. And I think Mike was also asking
Yeah.
about renovated homes versus land. Is it, which is easier and whatnot? It's much easier to buy land than it is to buy existing inventory or renovated homes right now, just because there is so little existing inventory out there.
Yeah.
So yeah, and you guys will see that as we are going to be doing the State of the Union next week.
That's right.
We'll be sharing that. We're also going to be doing a summit preview as well. So probably a good time for us to talk about that a little bit.
Yeah.
For those who have already have their tickets for summit, we're going to be taking about, well, I don't know, 20 minutes or so of the show.
15, 20 minutes.
15, 20 minutes. And we're going to be
orientation.
There we go. We're going to be giving you all the information that you haven't received yet. So giving you an overview of what we're going to be doing for those 3 days. We're going to give you some logistics and where you can stay. So of course you have all of your hotel recommendations. We do have some Airbnbs, some JWB Airbnbs that are available as well. We'll tell you how you can reserve one of the JWB Airbnbs to get the true JWB experience if you'd like it. Just as well as a few other things that are going to be really important. We can talk about the folks that are going to be there. Our sponsors are going to be not just any sponsors. They're the sponsors that you guys know and love. Yeah. Whitney Ritchie from Ritchie Insurance, John Siebert from Patriot Home Lending, and then Ian McKillop, who's going to be talking about estate planning, asset protection.
So many questions on the show about estate planning and
oh my gosh,
right? Like these are all value add sponsors that are going to come and be able to educate you on all the different things that you ask, and it is the innermost network of JWB, right?
Absolutely.
What do we have to look forward to in the? I want to get back to the show.
Yeah, we should.
Since we teased it, the State of the Union, GC. I really don't know much about it. Like I know that you were there last week doing it. What's a little teaser of what we're going to talk about on the State of the Union?
I think it's so insightful to see where the big players are putting their investment dollars and how they are arranging their business to take advantage of the market today. So we're going to open up everything that we are doing here at JWB, just like we shared it with our team last week. We're going to share exactly what our production schedule is. How many lots are we going to be buying, to answer Mike's question there and get more insight there, right? How many homes are we going to be selling? How many homes are we going to be renting? How many are we going to be renewing? We're even going to share with you a couple of additional and somewhat new things that JWB is going to be doing to take advantage of the marketplace as well. So share everything with you next week.
Interesting. We went over the planning. Now we're going to go over what that plan looks like, essentially, right?
Exactly.
Cool. All right. A couple more questions and we'll move on to the last topic. Patron Santorios, Michael Santorios says, Greg, I believe the administration floated the idea of blocking institutional investors because social media keeps blaming them for housing issues. By floating this idea, people are now being educated on the facts. For example, today's clickbait headline on the subject is that Invitation Homes, 89,000 homes, is buying ResiBuilt, owns 4,200 homes. Seems like a blip in the bucket when we're talking about those numbers in comparison to the rest of them.
Yeah, but to Michael's point, you read that headline, and if you haven't been a part of kind of this discussion, you read that headline, you start seeing 4,200 homes now being owned by a company that owns 89,000. You just start to think they own everything, and they've infiltrated my neighborhood. So Michael, I think you're right. The social media certainly makes certain headlines. I don't know. It elicits emotions for sure. So the facts and perspective really help to give the realness.
I mean, this is why podcasts have become such a great medium. And in a world where everything is about like a 1-second soundbite and having an immediate opinion, this like long form kind of like content where we get to talk things through. I get to ask stupid questions, you get to answer.
Yeah. I remember when people used to like actually have conversations to understand everybody else's opinion and, come to a common ground. I mean, and walk away as friends. That's been a long time since that happened.
And we're still friends. Yeah, I like it, man. David Blattner says, are there certain MSAs where institutions do hold a somewhat large percentage of SFRs? I thought I saw a post on X from Resi Club that said Atlanta had a lot of institutional ownership.
Yes, David, you're right. Atlanta, from the data that I saw, Atlanta actually has the highest percentage. Jacksonville is up there as well. So of the single family rental properties, the highest percentage will be somewhere around 25%. And it's not this slide because I didn't.
Oh, this is of single family homes.
Yes.
Okay.
So that the slide that we were just looking at is of all homes. Now, I think what David's asking about is just of rental properties. What markets are the most held by these institutions? And the highest percentage you'll find is somewhere around 25%. Atlanta is at the top. Jacksonville is at the top. And it's a lot of the Sunbelt markets, right?
Yeah.
Because it's the same reason that you and I want to invest in the Sunbelt, right? Cost of living is low, and rents are generally high enough to produce positive cash flow.
Yeah.
And it's where people are moving, so you expect higher population growth and higher home prices. So that's why they did it.
I would assume that institutions skew towards growth markets much more so than cash flow markets, right? At the end of the day, they get all the different benefits from depreciation and all these other things that are actually even more accelerated than the average investor, right?
Yes, they understand the 5 profit centers that we talk about. They get it, because when you're controlling hundreds of millions of dollars and you understand how your internal rate of return jumps up by being in a market that has significant home price appreciation, you are excited about putting a significant amount of your capital there. And so, yeah, that's why you'll see markets like Atlanta, Jacksonville, and a lot in the Sun Belt as being some of those more popular markets.
Yeah, got it. All right, last questions before we move on to the next headline. Juan Duque says, "Hi, Greg and Pablo. This is Juan Duque. Building on your analysis of institutional investors and these questions and the questions of which cities, states, and nonprofits may or may not qualify under a semantic definition, what are your views on the potential impact of the recent measures adopted by New York City under the COPA Act?" Are you familiar with this? I don't know what the
Unfortunately,
COPA
I'm
Act is.
not.
Oh, okay.
I'm not familiar with it.
It says, do you see these policies potentially benefiting more market-driven cities such as Jacksonville, particularly in terms of multifamily appreciation, by redirecting demand and capital allocation away from highly regulated markets like New York and towards less restrictive ones?
You know what? I think I can take this question, do a little bit more research, and come back to you on a future show, Juan, and give you a better answer there. Appreciate the question, and that's what we'll do.
Yep, sounds good. I'm putting it here in the notes.
Perfect.
So that I can give it to GC. All right, GC, we beat that headline up pretty good. Second headline of the day is this idea that this is no longer just a tweet, right? Like this is actually something that went into effect.
Now the next section we're talking about.
Yeah, yes. The next section is something that has gone into effect.
Yes.
And it's that Trump has directed the GSEs, right? This was a new thing. When you like texted me this headline, you're like, GSEs, MBS. I was like, I have no idea what you're talking about. And you're like, government, what entities? Government
Sponsored.
GSEs, government-sponsored entities, which is essentially Fannie Mae and Freddie Mac, have bought $200 billion worth of MBS's mortgage-backed securities, right? In order to try to bring down interest rates.
Yes.
Okay. Can you just explain to me what all that is?
Yeah. So Fannie Mae and Freddie Mac are under government's conservatorship.
Yeah.
So they are quasi-independent agencies, but they're under the control and the direction of the federal government currently. Okay. This was a result of the Great Recession. And so since then, they've been under conservatorship. Yeah. So, they are these huge entities that basically help you and me have the interest rates and the loan terms that we have, because what they do is they buy mortgages from your bank or whoever originates your mortgage. They package all of them up and then sell them on the secondary market to investors. It's called a mortgage-backed security. So that's really the role of Fannie and Freddie. And like I said, now they're under government direction and have been for the last, 15 years or so. So what's really interesting, though, is if we remember a show that we were doing a few weeks ago, 3-4 weeks ago, we talked about the end of QT, quantitative tightening. And that's really where the Fed, which is not a GSE, the Fed, the Federal Reserve, is a government entity. The Fed was actively, we were stopping the reduction of the balance sheet.
That's right. Taking it neutral.
We were taking it neutral, right? And we said, hey, listen, This is something to pay attention to. This is a signal here of that there is pressure on lower mortgage interest rates, and we are stopping the reduction of the balance sheet, which in of itself, it is the opposite of QE. Okay, so like QE is where you're expanding the balance sheet, and that's where you are driving mortgage rates lower. If you're stopping QT, it's not that we're going for lower mortgage rates there, but we're going back to neutral, and that was a signal to pay attention to. The reason I bring that up is because this news with the GSEs, Fannie and Freddie, buying mortgage-backed securities is very similar. It sounds and feels very much like a QE policy, which means a quantitative easing policy, which means more money into the economy, which means a move for lower mortgage rates.
Got it.
So
this is we first signaled that we went from tightening to neutral.
Yes.
And this is a signal of going neutral to softening, quantitative easing.
Through a backdoor route.
Through a backdoor route. That is something you were explaining to me earlier, right? So
Yes.
like this isn't now the Fed putting money back in the system.
Correct.
This is asking because why? Why take a backdoor route?
There are a lot of eyeballs on the Fed's balance sheet. We talked about how the Fed's balance sheet was up to like $9 trillion. Before the great financial crisis, I think it was like 1 trillion. And so nobody wants the Fed's balance sheet to get higher and higher. Well, some very smart person said, you know what, how could we get the same net effect of putting money into the economy and getting lower mortgage rates through directing the buying of mortgage-backed securities through the GSEs without it showing up on the Fed's balance sheet. So now nobody really pays attention to the balance sheet of Fannie and Freddie when Fannie and Freddie is directed to buy $200 billion of mortgage-backed securities. That shows up on the Fannie and Freddie balance sheet, but nobody really pays attention to that. So you get the same net effect of lower mortgage rates. It's not viewed by as many eyeballs because it's no longer on the Fed's balance sheet.
Got it. And there seems to be kind of like I don't want to say anything outwardly political, right? But like the Fed is its own institution. So the executive branch can't just tell it what to do, right? Like the Fed is going to do whatever it wants, but in a way to try to like establish what we're trying to create here, which is lowering interest rates, there is other levers that we can now pull in order to try to like create a back channel, right?
Yes, there's a separation between what the Fed decides and what the other branches of our government can do, but the GSEs are under conservatorship. So when the government says, buy this, the GSEs say, okay, you're the boss.
You're the boss. Yeah.
So this is a unique moment in time. And to give some historical context, there has never been another time where the direction has come from the government for the GSEs to buy mortgage-backed securities for the purpose of lowering mortgage rates. It's very discreet and done with intention here. This has never been done. I will say that the GSEs do buy mortgage-backed securities. They do have them on their balance sheet, but this is the first time that it's been done for this specific intention.
Yeah, that's interesting, man. I mean, there's two sides. Like for me, there's kind of like, I feel two different emotions here, right? Like I think we all want interest rates to go down. It's good for the economy.
Yeah.
I'm glad we are like looking for ways to do it. It also almost feels like a shell game. Like, aren't we like if we're just like, all right, well, where else can we kind of like buy this thing down and move it into some kind of like quasi-governmental like balance sheet here? Like, am I?
You know, I can understand your perspective. I think a lot of anybody's perspective on this is going to be heavily informed by how they feel about the nature of things, right? I think everybody's perspective is valid, and there I think will be some strong opinions. If you peel back, my job here is really to peel back the onion and tell you what's happening. All right, and everybody can decide, is it good? Is it bad? Is it good for now, but maybe bad later on?
Yeah, who knows?
Who knows? But yes, simply what's happening is that the net effect of injecting money into the economy is being done through a backdoor or a different channel that is going to get less eyeballs, and that's just a fact.
Yeah, and I guess as investors, I think it's just another telltale sign of like institutions, the government, like like it's as a country, we will always be looking at every option possible in order to keep the housing market going.
That's really the takeaway here. We have been talking about how when you make a decision to buy a single family rental property, you're not just buying something that is a hot stock tip, right? You're buying something that is a critical need for the family, for the community, for the city, for the country. And the federal government is incentivized to make sure that single family housing works. We have been saying this forever. It is the way things are. So when you're thinking about where to put your investment dollars, you want to be riding a wave where there is positive momentum that all key constituents need it to work. That's housing. That's single family housing, both rental and owner occupant. And, whatever the views are on, is this the right thing to do? Is this the wrong thing to do?
Is this a dangerous precedent or not, or whatever?
Could it be a dangerous precedent? I think all those views are very fair. Here's my take. I want to be in a position where I am going to benefit. My investment dollars are going to benefit from the writing on the wall. And buying single family rental properties is a type of investment that benefits because it is a critical need. There is a lot of momentum towards reducing interest rates. And it's been talked about for a long time. You're seeing some things that have happened just in successive months now with the end of QT and now the GSEs buying $200 billion of mortgage-backed securities. These are things that are moving in the direction of lower interest rates. And guess what? We've seen interest rates come down significantly over the last month and over the last year. And so connecting the dots here is as old as time. When interest rates go down, home prices go up. And so this is a moment where I am telling you, like, the writing's on the wall and now it's actually happening. You're starting to see interest rates go down. You want to be buying before interest rates go down as low as they can go, because when interest rates go down, home prices go up. And so that's what we see here. So I did pull some stats just because I thought this would be a good refresher for everybody. We haven't really talked about what interest rates have done so much, maybe in the last month or two. The average 30-year mortgage rate has dropped from about 7% 1 year ago to about 6%. And that's what this slide is showing. A huge difference between 7% and 6% when it comes to home price affordability. And guess what? Mortgage application data is skyrocketing, especially over the last couple of months as rates have come down substantially.
When you say a huge difference in the drop in mortgage rates from 7% to 6%, I imagine what you're talking about is like what we have continued to show over the show, like cash flows for rental properties are increasing.
Yes.
You're able to put less down as a percentage on the loan in order to get a cash flowing home.
Yes.
It's really starting to unlock. What was that? We had like a term for it, right? Like there was like
dormant equity.
No, I don't think I've ever heard that.
Oh, yeah?
No, yeah. But
really?
tell me
I thought I shared that one with you.
Yeah.
Well, so what it's doing is it's helping people unlock the equity that's already in their homes.
Yeah.
And I've just been trying to tell people, like, equity in your portfolio of rental properties is a wonderful thing. But if all of it's doing is just showing up on a piece of paper as like equity, and you have these goals that you want to accomplish, financial freedom in 5 years, 10 years, 15 years, you're just not maximizing the tool that you have, which is your equity. So, helping people see equity for what it is, which is a great thing. But if all it's doing is just sitting there, it's just dormant. It's just not helping you. That's a term that we share with clients and whatnot, but I guess I haven't shared it with you.
Well, we'll wait to it now, Jesus.
There you go.
Yeah. So I think, like all of these things are kind of setting up to a good moment of us getting together in the summit and being able to like look at what is the financial picture now. A year later, interest rates have gone down. There's all this dormant equity that's out there. We believe that this is the beginning of, a longer period of, if not neutral quantitative policy, maybe even like easing quantitative policy that may end up increasing home prices more than, like stuff like that, right?
Yeah, I don't know what policy is going to do. I'm not going to be forward looking on policy. Everything else you said there is what we believe, because number one, Jacksonville's rental properties already are performing. If I look nothing at like what is the potential positive that can come down the line, this investment is a critical need. It's been working for decades. It is built to supply your retirement goals, right? It is there. Now, and I'm not going to talk about policy, but look at what's happening in downtown Jacksonville, right? Look at what we all know to be true is that interest rates rose the highest they could ever rise, or the fastest they have in the last 40 years, and they stayed longer there than ever, and that there is a huge push for interest rates to come down at some point in time, right? and understand the connection between lower interest rates and home prices going up, I think a lot of people are going to make really good decisions over the course of the next year that are going to set up their financial goals to be reached quicker by understanding the connection here. And so that's a little introduction for the keynote that you and I are going to be putting together there.
I'm excited for the keynote for the summit. To put a button on this conversation then, right? Like this idea of GSEs buying MBSs.
Yes.
It's not a magic wand, right? Like it's not going to solve everything, but it is a step into a more of a quantitative easing policy. And we're starting to see this like combination of like all these different things that we're trying to do in order to start to bring mortgage rates down actually happen. Mortgage rates have gone down a full percentage point over the last year. And this is actually something that like really did happen, right? Like this isn't just kind of like a headline.
Yes, I'm going to leave you with the same takeaway that we left the last time for QT. We have to be paying attention to the signals here. And so what just happened, the $200 billion of mortgage-backed securities dropped interest rates about 0.2% over the last month. That's a significant drop, and it gets us to about a 6% average interest rate across the country right now. We don't know if this plan for $200 billion of purchases of MBS is going to continue. We don't know what the lasting effects are. It might be a drop in the pan and then never be done again. But what we are seeing is that there is a push for lower interest rates on mortgages. And just understand that. Pay attention to the signals. We'll do our best to keep you informed. Make the connection between lower interest rates, higher home prices, especially if you're backed by a market where there's already growing population and you have $6.5 billion of development going on downtown.
Well said, buddy. That was a good one, man. When you texted me these first couple articles, like I was just like, I kind of understood the first one, had no idea what the second one meant, but I feel like I'm walking away with a much better understanding. Super pumped for the State of the Union next week.
Yeah, it's gonna be great.
I think it's gonna be awesome. Really, really pumped to give the preview for the summit as well. I want to thank the community for being here. We had many of you here today that take every single Tuesday and take an hour out of your weekday to get educated, see beyond the headlines, engage in these like long-term discussions about stuff, and come away as friends no matter what we believe politically or policy-wise or whatever. So we're going to keep doing this thing. Can't wait to see everybody in a month. Any last bits of advice before we get off here, GC?
Don't be average.